Hello, you're watching the business headlines on HW News with me, Ali Azhar. The Reserve Bank, in its bi-monthly monetary policy meeting, or MPC, cut benchmark interest rates by an unprecedented 35 basis points, or 0.35%, which now takes the repo rate, that is, the rate at which RBI lends money to other banks, to 5.4%. At current levels, the repo rate is the lowest since 2010. Prior to this cut, rates had been reduced 3 consecutive times this calendar year, each by 25 basis points. And if we include this one, it takes the total quantum of rate cuts in 2019 to 110 basis points, or 1.1%. And add to that, the RBI has maintained an accommodative stance, which means that it is willing to cut rates further going forward. That's indeed a steep rate cutting cycle that the RBI has implemented ever since Shaktikanta Das took over the reins at the central bank. A conservative economist such as the former RBI Governor Urjit Patel might not have agreed with it, but that's a discussion for another time. Building up to the meeting, a demand for a rate cut had been made across the spectrum, from politicians in Delhi to fund managers in Mumbai. It's no secret that India is in the midst of an extreme slowdown, and for those saying it's a cyclical thing, they couldn't be more wrong. A combination of stressed macroeconomic indicators makes for a disturbing reading. GDP growth is at a 5-year low, fresh investments are at a 15-year low, unemployment is at a 45-year high, growth in gross tax collections is at a 10-year low, core sector growth is at a 4-year low, auto sales are at a 2-decade low. Tough decisions and policy actions to better the situations are not being taken by the government. They just do not seem to be acknowledging the fact that our economy is in the doldrums. In fact, the latest budget that was meant to revive demand, encourage investment and kickstart the economy failed miserably. Proof of that fact is $200 billion of market cap has been wiped off from the stock market since the budget. It ushered in unfavorable rules for institutional investors, and as a result, foreign capital and FIIs have been exiting India faster than ever. Amid these testing times, the government has no other option but to convince the RBI to cut interest rates in their last-ditch attempt to encourage growth. I use the word convince because let's remember that the RBI is presumed to be an autonomous body and is expected to be independent and free from government intervention. Rate cuts should only be made when inflation is under control and the state of the economy demands it, and not when it's convenient for the government. To be fair, the headline consumer price inflation or CPI is at 3.18%, which is well within the MPC's target of 4%, and growth rate has also been revised downwards. So one could justify a rate cut. So rate cut it was. Now, another aspect to this is transmission of this rate cut to the final consumer. This means when will our EMIs for home loans, vehicle loans, personal loans, term loans, etc., when will they reduce? It's only when our EMIs become less will we encouraged to be borrowed more and in return spend more, and that's how the economy will kickstart. I mean, isn't that the whole point of this exercise? Transmission of interest rate cut is where our system has let us down. It is also worth noting that the RBI has flushed the banking system with additional liquidity. So, in spite of having a liquidity surplus of 2 trillion rupees and multiple rate cuts affected by the RBI, still lending activity hasn't improved. Few banks such as SBI and HDFC Bank have passed on minor benefits to their borrowers in the form of reduced interest rates for fresh loans, but nowhere in the same proportion to how the RBI has cut rates. It is because the final consumer is not getting access to these reduced rates is what is holding the economy back. The most important reason why we do not get the benefit of reduced rates is because of the borrowing spree the government has embarked on. The more the government borrows, the less is available for private sector. And interest rates at the end of the day are a function of demand and supply. This means that if the center keeps borrowing and exhausting funds available at lower interest rates, others are left to borrow at high interest rates. How this is done is like this. The government likes to say that it maintains its fiscal deficit target, which is the difference between its revenue and expenditure. This excess expenditure of the government over its revenue is met by borrowings. The center has set a fiscal deficit target of 3.3% of GDP for itself for the year 2019-20. The fact is that the government has not been able to maintain this target and has overshot it for the past years. A latest report by the CAG, which is the authority that audits the receipts and expenditures of the government, has suggested that the center has manipulated this figure for financial year 2017-18. The government makes public sector enterprises borrow and spend on its behalf and then says that they have managed to stick to the fiscal deficit target. So, the Food Corporation of India has been made to borrow in excess of 1 lakh crore rupees from the market and spend on food security of the country on behalf of the government. And this is not reflected on the government's balance sheet. Meanwhile, the finance minister comes out and says that we have achieved our fiscal deficit target. Other public sector enterprises have also indulged in such borrowings, leading to the fiscal math being manipulated. And worse, this increased borrowings by such PSBs has led to crowding out of private sector borrowings. Another reason why banks are finding it difficult to pass on reduced rates is because of deposits. Public deposits are the lifeblood of banks, especially in developing countries like India. Since competition to accept deposits have risen sharply in the last few years, with new small saving schemes, post office deposits, etc., banks cannot reduce their interest rates on such deposits or they will lose business. Hence, interest rates given on deposits, which is an expense for the bank, remains high, and consequently, they have to charge a higher rate on loans given out by them to compensate. Additionally, banks link their interest rates to their incremental cost of funding via a mechanism known as MCLR or marginal cost of lending instead of external benchmarks such as RBI Repo rate. This results in a much slower transmission of rates, and banks must be encouraged to link them to external benchmarks instead. Finally, since the economy is in such a depressed state, household savings have fallen. Household savings are the backbone of the economy, in the sense that most of such savings are mobilized into deposits. And the more deposits that banks have, the more they can lend money. So, with total borrowings of the government and PSUs going up and household savings, which are needed to finance them, falling dramatically, one cannot expect interest rates to fall by much. I would now like to bring your attention to the fact that the country's largest lender, SBI, has cut its home loan rates by 15 basis points or 0.15% just hours after the RBI announcement. While this is a step in the right direction and we hope that more such announcements are made, the truth is that this is just one bank, and that to a public sector or government bank cutting rates for home loan rates only. It's when private sector banks join in and cut rates across the board for all types of loans is when the economy will truly begin moving forward. Thank you for watching HW News. This is me signing off. Have a great day.
Namaskar. HW News Network today is a year and a half old. Thanks to your support, thanks to your love, we've grown. We require your support a little more. What we request you to do is to download our free app. Our app is in English, Hindi and Marathi. We promise to update you with the latest news, views, analysis, interview. We also have a live TV going in that. If you download our app, we will get advertisers. And if we get advertisers, we'll get revenue. We get revenue, we can serve you better. So once again, please do support us. Please download our app. Namaskar.